Hello, everyone, and welcome to this keynote interview for AIC Conversations. Today, I am very excited to introduce Jonathan Nelson as our next speaker. Jonathan is the founder and executive chairman of Providence Equity Partners, the global media, communications, education, and technology-focused private equity firm with around $49 billion in assets under management. Jonathan is a renowned businessman famous for pioneering the sector-focused private equity approach. He holds a bachelor's degree in economics from Brown University and earned an MBA at Harvard Business School in 1983. Today, Laura Kreutzer will conduct the interview with Jonathan. Laura oversees a team of editors and reporters that cover private equity for the Wall Street Journal. She has covered private equity for 20 years and is also a former Sunday columnist for the journal. Laura speaks Mandarin and Japanese, and before embarking on a career in journalism, spent 6 years living and working in Japan and China. She holds a bachelor's degree in East Asian Studies from Brown University and a master's in International Media and Communications from Columbia University School of International and Public Affairs. And on that note, I'll hand it over to you, Laura.
Thank you so much, Paul. And thank you, Jonathan, for taking the time to speak with us today. I'm so excited because as many people might know, Jonathan founded one of the first and oldest and largest media-focused private equity firms, but has done an excellent job of staying out of the media spotlight himself over the years. So this is a great opportunity, and I'm thrilled to be able to talk to you about your wonderful career and investment accomplishments. But before we dive into that, I'm hoping we could take a minute to talk a little bit about what's going on right now in Washington. As I know that you're very passionate about our country and the democratic institutions that are at its foundation. This week, just a few days ago, as I speak, we inaugurated our 46th president, Joseph Biden, into office under the tight security of thousands of National Guard troops, which certainly feels like a first in my lifetime. And President Biden takes office at a very divisive and delicate moment for the American body politics and American citizens. And as a business leader, I'm hoping we could start with perhaps getting your insight and perspective on what role the business community and business leaders can play in helping our country to move forward.
Sure. On this date, it's probably a very good place to start because it both transcends what we all do day to day, but it also, there are some aspects that I think are relevant for business and even media that we'll probably get to in our conversation today. So let me just, at the outset, by the way, I think it was an amazing rebound in 2 weeks to go from a mob takeover of the center of our government to an inauguration based on a full and fair election. By the way, at numbers we have not seen before in totals, votes, and a scrutiny that we had not seen nationwide before. But there are two pieces that I think are especially relevant for our conversation this morning, Laura. One is the role social media has played in this. That's something close to what we do. I think it affects all of us around the world. That's what's different. That was an enabler, I think, of what we saw. Yes, the president had a role, but he had a weapon, social media. The social media that ultimately responded in first warnings and then later taking down what they thought were messages that were likely to lead to violence. Remember, this was the banner was, stop the steal, was promulgating the lie that this was not a fair election. I'd be upset too if I really thought this was unfair. I'd be very upset. I'd probably be protesting somewhere peacefully, except that that was a falsehood. but it was supported and encouraged and organized by social media. And then you layer in foreign, state actors who, like, for whatever reasons, fomenting upheaval. And um, the idea that we were scrambling at the 11th hour to develop rules of the road, even though I agree with taking down those messages, deep down, I think this is a slippery slope. We should not be, those that didn't like it and would call it censoring, yes, I don't blame them. But doing it in the heat of the moment strikes me as dangerous, necessary then, because we hadn't done it before in a thoughtful way. And I think we need to do this, because these forces are not going, I don't mean this specific group or this or Donald Trump. I'm not talking about that. I'm talking about, why would any election anywhere not have to deal with this very powerful force? So we used to have in media the fairness doctrine. You'll remember that. Depending on the age of students, they might think, what was that?
Yeah.
Well, it was a kind of a very simple rules of the road for broadcasters, and dealing with essentially two parties, and how parties had a chance to evenly dispute or make their case before all the viewers on that was television. That's gone. By the way, that simple doctrine, while it worked, wouldn't work in this setting. But we need a thoughtful new version of something like that. I don't think you can do it on the fly. Right. I'm not one who's given to, like, regulation categorically is good, but there are cases where we need it. And this was one. So I hope we turn to that, because that weaponized forces that will always be out there. Fringe groups, just that's when you have large numbers, in the case of the US, 330 million people, give or take, plus outside parties have interest. You have to watch out for that. That's a new dimension that our forefathers could not have imagined. And by the way, if they could have, that would have made them the ultimate great investor, to be 200 years ahead of your time, so or more. So that's one aspect that I think is relevant for conversations like this in the audience. The second, it has to do with the role of companies and in particular business leaders. Business leaders in the US, many, not all, were had a role in this, were complicit in what happened. And I know that sounds really critical, but I think an honest discussion about this is really instructive. So yes, it's a good thing that money was pulled from those who were inciting a decertification of a fair election. That's good, but that came very late. What happened in the weeks and the months leading up to this? I think what was happening is that CEOs were tilted towards what's in their company's interest, what's in their interest. That was economics. That was a cut in taxes, just to put it right on the table. Right. Lower taxes and lighter regulation. Those two things, I think, led many CEOs to hold their nose and be supportive. And I think we need to revisit that as a group, because we've been in a new, I would say, a different world for, it's a question of whether it's years, 5 years, 10 years, where the responsibilities of CEOs is not just earnings per share, if you're a public company, stock price, or if you're private, cash flow. We now have a responsibility, and I think every good CEO would say this and generally behave this way, to consider social justice, equality, inclusion, diversity. There are many other goals that have nothing to do directly with earning a profit. That duality of earnings and social responsibility all good CEOs recognize this. But with this one large exception, I think we tilted way too far in one direction. Now that's a view, and I'm trying not to be political about this. This is not a Democrat versus Republican argument I'm making or positing. It is just what I think we were experiencing. And in the same way, we need to look at social media. I think we have to look ourselves in the mirror and say, aren't we better than that? And don't we have greater responsibility? We can talk more about what Providence is doing and what I'm doing
that'd be great.
later if you like. But those two concepts, I think, are relevant and conspicuous in what led to all this.
Yeah. Can I ask you something? I'm jumping around a little bit here, but I think it's might be good to bring this in because I think if there is one thing that was really obvious for this whole experience, as you mentioned, is the power of social media and the influence and that many of these large platforms have. And I think it's something that from both sides of the political aisle, we've been hearing questions about the breadth and the influence of some of these platforms and whether there needs to be more antitrust scrutiny of some of them and how they're operating. And I'm curious, as you look at sort of the coming year or 2 years and we have a different administration, how do you see sort of the specter of perhaps increased regulation of these big tech and social media platforms maybe affecting the way you look at or even operate your portfolios or look at investing?
Yeah, so I think you're right. Every time there's a change in administration, doesn't matter which direction, the expectation of a change in regulation, that probability always moves up. Now it's heightened in this case because it actually was in the news before this. I mean, there are two forces for regulating big tech, including social media. One is from an antitrust perspective. I don't know how you would actually break them up. It doesn't actually make sense. I don't think there'll be a good structural solution. It is the nature of networking and the power of networking. You succeed when you achieve scale. I think that's actually been one of the issues is how would you, Google is largely a search engine. How would you break that up? And what would you achieve? Now but there's another remedy when it comes to antitrust concerns, which is behavioral constraints. Much harder to monitor, requires much more thought. I think it'll be a more productive path here. So we've had that before this election. You could see that in Washington and indeed in Europe, which has actually taken a tougher stand on antitrust issues based on a different body of law. But then the second piece has to do with censorship and influence. And that's the piece I was just talking about, but I think that's coming, and much as I believe in the power of private enterprise, we do need some thoughtful rules. And it's not obvious, and I hope cooler heads prevail here. It's not a time to be political. It's a time to be above that and smart. And gosh, that sounds like a very tall task.
I think it is a tall task. Well, I do want to talk a little bit about your career because I think it's a really interesting one, and we will get back to talking about the media landscape for sure. But to take a little step back and maybe go back to the very beginning and talk a little bit about your origin story as an investor. You were born and raised in Providence, Rhode Island, biggest city in the smallest state, and went to college there, stuck around in Providence, named your firm after it. But you majored in economics at Brown, and I understand you even had a jazz radio show as a college student. I'm wondering if you could share with us, thinking back to those days, and tell us a little bit. What did you want to be back then when you were a college student?
Yeah.
How did you envision your career?
By the way, I didn't mention I did have a jazz show at night for years, and I never mentioned it probably for 3/4 of my career, because I didn't want anyone to think, oh, so that's why you're doing you're a frustrated musician or disc jockey, and so that's why you're doing it. I didn't want to really go there. Although I did hear from a team member just 2 weeks ago, we have a music festival, actually a collection of them in Europe. We're building out the platform, but they're music festivals, and we're really proud of it. He said, you're part of our message to winning over partners is tell us another firm founder that had a radio show and is on the board of the Newport Jazz Festival and Newport Folk Festival, which I had no idea. I just found that out recently. So I guess the cat's out of the bag. I actually had not the foggiest idea what I wanted to do when I was in college. That's the honest.
That's so comforting.
I had no idea, and I seemed totally unbothered by that. That I studied anything that I was curious about, not with a goal in mind after school. Now, this as an undergraduate. And I was fortunate, and it wasn't accidental. It's a big part of why I went to Brown. And you know this, well as a graduate, that it's an open curriculum. So you have the freedom to study anything you want. And by the way, I've heard instructors say, I want a class full of people who want to be there, not have to be there. It's a liberating and essential part of the Brown approach that was perfect for me, because from music to math to physics to economics, I was all over the map, happily so. None of it was designed for a career. And I'm afraid that students today, when they look to examples, including me, because I've had many conversations with students, undergraduates and graduates, who assume that I had a plan back then to do what I'm doing now. Not true. In fact, I wouldn't even advise such a plan. At that age, you should be thinking about learning for learning's sake. You should be pursuing what moves you. It's such an indulgence to be young, and if you can, be learning about everything under the sun that captures your fascination. So that was me. And then all of a sudden, graduation was approaching, and I knew I needed a job. I needed to make money, like right away. And I actually went to an interview. A friend of mine who didn't go to Brown was working for a Boston-based company, but he was largely spending his time in Asia. And he gave them my name. So I actually had to find, a decent pair of shoes, which actually, in hindsight, I flunked that. I put together an outfit, set my alarm, because I did a radio show late at night, so I hadn't seen an early hour of alarm clock. Went up to Boston, met the president of this. It was a large private company, and for me, I just wanted to get an interview under my belt, so that once I had some idea what I wanted to do, I might be better at it. Anyway, long story short, they hired me and he had an idea about building a business in China. Now, it's funny that you were interviewing me because you would be a much better candidate for that position as an East Asian studies major than I was. And he told me, I said, well, do you want references or grades or any of that? He said, no, no, no. I was kicked out of college. He said, he didn't say that. He said, I never finished college. I later learned that it was an abrupt end to his formal education. He said, I'm just looking for certain, someone that resonates with me. And I have this idea about building out a business in China. And I thought, oh, this sounds so cool. I really want to see the world and someone's going to pay me. And this is what a great learning experience. And a week later, I was.
Wow.
And this is in the 70s.
Yeah.
I mean,
China was just opening up.
77 to, for the next 3.5 years, that's what I did, was helping companies operate in China, which then was off limits to just about everyone. In fact, there were very few Americans there. You could count them on two hands. And it was the change in China from then to today would be a century of change for most of the world. Certainly the developed world. It's unbelievable. But I learned a lot. Obviously, I learned a lot about China, which has been helpful today. And they're such an important part of the global economy, arguably the most important part, as a country and its reach. And I learned about people generally. My clients were in Europe and US, and I spent most of my time in Asia, and China in particular. So what a great opportunity for a kid who had no idea what he was doing. And lessons kind of learned in that period or with me. I also should say that, and this is central to how I think about career management and a life lesson is, and so to the LSE students who are thinking about what they want to do, to choose a path when you're young, in life terms, to maximize some endpoint is really not a good strategy. Life doesn't work that way. And you will blow a more important opportunity to follow what you're passionate about, what you actually care about, as opposed to what's popular or what's more remunerative on an expected basis, or whatever other reasons are, which shouldn't be the propelling, force. And I'd say almost everything I did, it was really just following my heart. And it would be false to think I'm sitting in this chair now with a lot of hard work and a lot of luck, that it was a consequence of a scheme hatched when I was in college. That couldn't be further from the truth. In fact,
go ahead.
In fact, when the line for me of learning every day in China, it was very steep learning curve for years, but when nothing grows unabated, just at terrific rates. When that started to level off, and by the way, what an incredible time! This was right after the fall of the Gang of Four. This was the reemergence of Deng Xiaoping, and a program that continues to this day, decades later, really 40 years later, he set in motion. That's planning, not the kind of personal planning I did, not the kind of planning you see in the US and most economies in Europe. They're still on their plan, a series of 5-year plans, but they're on it. That's when my learning started to taper, and I realized I didn't see myself living there. And I wanted to, I was ready for a change, but not ready to come back to the US, and I moved to Sweden. Nothing to do with what I do now, except that I met my wife then, and that worked out incredibly well. But then I went to business school, and it was only at that point you could say, oh, now it starts to look like a plan.
Yeah. And then you you went, actually, one little short thing I want to interject, because I think people might be interested. You almost ended up, you could have ended up as an LSE student, I understand. You tell us that
Yeah,
story?
So that's true. And since I'm not one to look back, I'm just looking at forward. I haven't actually talked about it with anyone until we got together with Paul to talk about what we get, about what this is, these conversations. And I said, I was within a whisker of actually being at LSE because of I was an economics concentrator at Brown, and it really came from one of my professors who said, you should take a look at LSE. You might want to spend time there. And I thought, this is great. I applied. Now, this is a world without internet. This is, everything was postal, not postal as in, I mean, communications, written, mail. I may just have lost 95% of the audience with that, but I didn't hear back. So I thought, okay, they acknowledged the application, but that was it. And then as junior year was starting, I get this letter, I've been accepted. And I thought, oh, this is great and difficult at once, because I wanted to go, but I don't have housing. I've now committed to housing in Providence. I can't get out of that. There was a financial cost and so it was just too late when I got the message, the response by mail. And I don't know, it's probably too late to reapply.
Oh, you never know. You never know. I bet they might make an exception. But I want to talk about the birth of Providence Equity Partners, your firm that you founded in 1989, I believe. And I know prior to Providence, your first private equity job was at a firm also in Providence, I believe, called Narragansett Capital, correct?
Yes.
And then you worked there with, I believe, Glenn Kramer, who also co-founded Providence with you. Together at Narragansett. And then in 1989, you decided to strike out and launch your own firm at a time when there really weren't sector-focused private equity firms. I'm hoping, you could walk us through a little bit, like, what were the criteria you considered when you were deciding to focus on media and communications, and what sparked you to take that leap?
Okay, so that's a lot.
Sorry, I'm throwing
those
a
are
lot.
Great. No, those are good
in.
questions. Those are good questions. Let me try and deal with them one at a time, and hold me to responding to everything.
Oh, I will. I will.
When I was at Narragansett, I did one non-media deal. It was my first deal. It was actually to acquire the company I worked for in China. which had, we don't have time for that, except it was a great deal, a fabulous deal. And it's a good way to start a career with a great deal. Conversely, if your first deal is horrible, that might lead to a dead end street. So I decided that I didn't want to pursue deals opportunistically. I wanted to develop a relative expertise to advantage the firm I work for and me in evaluating and finding and companies. And so for me, it was cable television. And I'll come back to why in a minute. So the idea of focus was on my mind, not to raise a fund or leave the company. That's where it started. And I had certain criteria, which we come back to, about why media, because it could have been anything. I could have picked anything. And so that was number one. And we probably should return to what the qualities of media that led me to that. Number two was why start a firm? As I mentioned, my early deals worked out very well. I was offered a partnership, and why wouldn't you accept? And when I joined, and they made me an equal partner, which was awesome. And when I went to my first partners meeting, I looked around the table and I said, oh gosh, I'm not sure this is going to work as well as it could. There wasn't a real leader. There were varying skill sets and not a unifying theme that I could see about values and how people interacted with one another, because the group was a consequence of someone else's hiring over time. It wasn't a group of partners that came together. It evolved over time in the context of a public company when that group originally got together. And I knew I wasn't proposing myself as a leader. I'm the young guy who just got into the room, so it wouldn't be me. And I didn't see I saw a group of equals, and I thought, this isn't going to work so well. And then we were doing fine because it wasn't a very competitive industry, which I thought was going to change. These were early days. And I said, I'm doing well, but that was another life lesson. Doing well apparently wasn't good enough. It wasn't about financial success. I wanted to start a firm with a different culture, a shared set of values, because you spend so much time with one another. There is such mutual trust when you're dispersed out in the field, dealing with people, that was really important to me. And I wanted to focus because I thought that would lead to a competitive advantage by focusing on an industry or industries. So that's why I started a firm. It wasn't to do well. I was doing well, especially at that point in my career. It wasn't to build an enterprise with 50 billion of assets under management, nothing like that. I just wanted a company where the partners all were on the same page, had the same spirit, the same values. I wanted that, and I wanted specialization. And for me, that was media. It started with cable TV, and it branched out and has continued to branch out over the years. And I didn't think about the risks of starting a firm. I didn't give much thought to how difficult it would be. It's a good thing because it was much harder than I thought, took much longer than I expected. So ignorance was a good thing, and I had a recession, a Gulf War to fight against, a new name that no one recognized, a very slim track record, positive, but not compelling, I would say. And I was very young, and that sounds like a bad mix. And and indeed it was. I think I met with 400 investors, and um, 393 of them said no. By the way, when I say no, most of them said no. The rest of them never called me back, so I
Oh,
took that as a no.
those that gave you a
Uh,
call back
yeah,
said no.
and the 7 that did, most, they're if those entities are still around because it's been a long time, they're still with us. So that's pretty. I love that.
Testament.
And uh, it it took more than a couple of years. The first fund was $171 million, and I was over the moon because I thought I've now got the blank sheet of paper that I wanted. I can build a team, and we can prove that specialization works. By the way, back then, I should have added that to the list. Our investors had only invested, the prospects had only invested in generalist funds. So the idea, other than real estate, specialization was foreign to them. So that was also trying to push a ball uphill because they didn't have that allocation in their mandate. So, um, but obviously it worked.
Indeed, and worked well.
Worked, yeah, and there's another point in there about my take on on successful entrepreneurs, which is we tend to look at successful entrepreneurs when they're conspicuously successful and say, okay, this is great. And I don't mean to end the interview because that's not valuable. But the real learning is what happened in the early days. So it was smart of you to ask, and it's not like, oh, look how well they did, because I believe that entrepreneurs, the ones that I know and have studied, they never set out to make um, a lot of money or to be a high profile. They were moved by an idea. And I could go through the list. I won't now, but they weren't dreaming of the very things that attract attention much later as icons of entrepreneurship. The real learning is what was going on in the beginning, which almost always is hard work, almost always following a passion and just conviction on it. And it was not a financial success. That's been my take.
And Providence grew, quite successfully. That early hard work paid off. The other thing I've learned from talking to people, I think too, people learn from that hard work and those early struggles, but they also learn when they make missteps, right? That some of the times I've grown, certainly as a manager, were the times I kind of screwed up a little bit, or just things didn't turn out the way that I had hoped they did. And that's where you learn and grow. And so I want to talk a little bit about the GFC, the Great Financial Crisis, and the buyout boom of 05, 06, 07, and the fallout, because I think Providence, did have its share of pain. If I think about Integrity or MGM, there were a number of deals that probably didn't wind up sort of as you anticipated. And I'm curious, as you look at kind of the successful deals and maybe the ones that weren't as successful, what are some of the similarities and differences that you've taken away from that as you look back?
So I have always said, and I've never ducked the mistakes. And by the way, a lot of our successes, hard work, backing talented people, and some luck. The mistakes, I believe you learn much more from mistakes. And it's probably more helpful to say, I made a mistake, and what about that am I learning? So I don't do that again. We'll make new mistakes down the road, but we're not going to repeat old ones. And And then when you have learned enough, you tend to be what we call old and hopefully wise. So I think for us, the mistakes were about, this is a people business. And there are two sets of people that really matter. The set that you invest in, those CEOs and senior management teams, and the people who you entrust to engage with them, evaluate them, support them, to help them in their life as a portfolio company. And those would be people, in our case, who are resident at Providence. And when you're growing it really quickly, two things happen. As in a growth environment, most of our mistakes were just before the financial crisis, was backing oftentimes not the ideal team and not acting on it. And we had folks at Providence who weren't as skilled, and we didn't know that because of the fast growth of the firm. By the way, that happened with managers and investors alike. That there's a reason why that was coincident. It was the same environment. And so you have to take a cold look and say, okay, who's really good at this and who's not? And should be a meritocracy. That's how investors look at funds, and that's how fund managers should look at themselves. And that means promoting good people and retaining them and supporting them. And when they're not, help them find something else to do, or don't put them in a position of trust when they're out in the field and you can't be everywhere. And so we own that. So those were really people issues. Yes, there were some business issues, which we always learn from, what not to do again, whether it's misunderstanding pricing power or demand or competitive behavior. That stuff is very basic and easier to quantify. The part that I love about this business is it's still a people business. Which is why I'm not in the hedge fund business. I love private equity. So yeah, there are always learnings, and just over time, if you're doing something for 32 years, you will make mistakes and you'll have a lot of successes. And I say that relative balance, there have to be many more successes than failures, because otherwise you don't get to 32 years. That just couldn't happen in a world where capital is allocated based on success.
Yeah.
So that was 10 years ago. We have been, for a couple of funds, back to the level of success that we saw in the first 4 funds, and that was so much fun. Our team works really well together. They're really smart, and winning is more fun than not. Yes, but it starts and ends with people.
Yeah. As you look at the current environment, some people make a comparison in some ways to that environment, that sort of heady buyout period before 2008, where right now private equity is sitting on a record amount of dry powder. I think it's over $1.5 trillion, and purchase price multiples for good companies seem pretty full, and interest rates are low, so it's fueling a lot of and not to mention the SPACs that are prompting, I think, some pretty high valuations and some bidding wars. How is Providence, and how are you sort of navigating this tricky environment to make sure you're not going to repeat the mistakes of the past?
Yeah, so a couple of things. Little context. The idea that there's too much private equity and prices are high and competition is ferocious, I think defines about, if I look back over 3 decades, roughly 90% of that timeline. If you were to be honest about how you felt, if you were honest about it in the quiet of a being alone in a room thinking about the responsibilities of managing other people's money and say, oh, it's very competitive. Competitors are really good. Maybe things are seems a little frothy or frothy. Isn't that a concern? It's always been there. And by the way, SPACs, they're generally doing things that funds aren't doing, and they represent more exit opportunity than a competitor for us.
Yeah.
And I'd say most private equity folks feel that way. So I'm not worried about that. And plus, there's been an evolution already there where these pipes where you get sophisticated investors coming into those deals, looking at it freshly. And so for those investors, retail investors in particular, who are not trained or don't have the time or the resources to do that kind of diligence, they should know that sophisticated institutions are. So there's a check and balance in that system. It's grown like a weed recently, which should be, catch everyone's attention. But there is a reasonable test with all of them. Or most of them. Competitors have always been talented. There's always been more money than deals. It's always felt that way to me. So now that's context. What about Providence? So for Providence, our response has been focus on areas we really know. By the way, that's a lesson learned. Different period. And develop a plan that allows us to break the link between the environment and what we really need to do, which is build equity value. And so generally when we invest, we're building a platform company. For example, I mentioned earlier in this discussion about our music festival roll-up in Europe. But I think if we were to go in and buy the competitor Live Nation, that would be a high multiple. That doesn't look like our multiple because we built it. So many of our successes we built. And that's different than most funds that are looking that for such scale at the outset that they're competing generally with other private equity funds or a public market, which is very, it's about high valuations there and overpaying or paying a high multiple for growth or both. So we're trying every place we can to build businesses and to play into businesses where demand is growing and where we see unmet ability by current players to satisfy that demand. And then finally, it has to be in spaces we know well, which is media, communications, sports, education, software services, and generally those services are around those verticals I just mentioned. So that's what we're doing. It has worked very well. And, at some point, the markets, trees don't grow to the sky. Right. So there'll be a reckoning, which is why we're always selling. We're not just investing. Again, that was a lesson learned.
Yeah, and let's talk a little bit. That leads into kind of, and we'll get back to sort of the future media in a bit, but just talking about the past year, very unique experience, I think, for a lot of us, this pandemic and the challenges that it has presented. I think the shifts that it has prompted in how we think about work and how we organize for those of us who are privileged enough to be able to make those shifts. And I'm curious if you might share with us a little bit how the coronavirus pandemic and the way you had to pivot, like in what ways did that test Providence's corporate culture and what did you learn from that experience? Mm-hmm. Or are learning, we're still in it, I guess.
We're still learning, but we know so much more than we did in the first week of March last year. So I think that when I look back at the 30 years at Providence, this will come down, I'll remember this period, the trailing 10 months as a period where I'm proud of what we did, a period of learning, of an inflection point in the conduct of companies and how they operate. I'll get to this why in a second. In other words, other than the misery of COVID itself and its and the devastation to so many families, but when it comes to Providence, when I say Providence, in this case, I'm not talking about the city, I'm talking about us. Mm-hmm. I will think about it in terms of a highlight, and that may be surprising. And so what do I mean by that? First, I don't think there's ever been a better period where we didn't look after one another than this one. And that's incredible. And by the way, all of these things I'm about to describe, these qualities, I would never have guessed. They were surprises. I'll give you some examples so there'll be some meaning to what I'm saying, which is we quickly made sure that everyone from top to bottom was connected to everyone else. Our IT guys, that group did a fabulous job coming into it. So we knew the capabilities of what every home had for remote connection and supplied them with whatever they needed and built laptops and all that. So we were ready. And that was early. That was the second week of March. We had we're too large a group to all convene on Zoom because what happens is no one raises their hand. Not enough. You know that it's a group dynamic. That's for psychologists to evaluate. I'm an investor. And we broke it up by offices. New York, Providence. We're also in Boston and London. And we had regular group calls. In the beginning, it was every morning. And I would jump between the Providence and New York office. And it was not just for managing directors. That's not what I'm talking about. This was everyone from assistants to the senior most managing director. And there was something about it which we would not normally have, for example, in an investment committee meeting, which I chair. And I can tell you that over the years, the junior most members of a deal team presenting, they don't say much, understandably. In these calls, by contrast, everybody had a voice. In fact, we made sure of it. So if we had trivia questions, news items, and we tended to purposely stay away from politics and COVID. So it was a little more uplifting and, you know, things people found interesting. And I saw some of our newest associates speaking. Of course, it helped me that I could see their name too. I've always been better with faces and voices than names. But so I could see them and I could peer into their homes, or in many cases, their parents' homes. I knew more about that group than, that's how I feel, than I have since the early days of Providence. So there was a real connected feel, and we provided support systems for everyone, which of course, you know, that need spiked as a consequence of COVID. I could literally see how some people were simultaneously working, parenting, teaching in a small space that was never meant to do anything other than parenting. And those were typically urban settings. But so I was so proud of how we came together and looked out for one another as our little community. That's at one level. Then there was the enormous support for the portfolio companies, where the range of impact of COVID was everything from, oh, it's a boost to the business because their services are, because, you know, we have a lot of digital businesses which lend themselves very well to a remote working environment, to live businesses, which would, where revenues were hammered. And so we had to support them to fight another day and how to get there and keep the, skilled labor and so forth. So the portfolio work ramped up, which I think is what distinguishes this industry. That's what we need to do. And even more so in an environment like the last year. And then we started to turn to those things which we always need to do which is invest in new companies, sell businesses, onboard people in the company, at management teams, all the fundamental activities, which are always collaborative. It's not an assignment that I could say, Laura, can you do this or that? No, they all involve groups. And this is actually a rare thing for me. This is, I don't need a group at Providence to do this. I'm doing this, but that's a rare event. The typical event is a group setting. And so coordinating that and not skipping a beat, I never would have guessed, to be honest. And I think we're stronger for it.
Let me ask you, how private equity has always been like a very travel intensive business, everybody, there's sort of the deal team, everybody's got to be there in person. You want to have that face-to-face time. But yet, in COVID, people have learned how to do that without that actually, and adapted to it. And I'm curious, in what ways do you see some of the changes that the way the private equity industry has operated being more long enduring, even after the COVID crisis passes?
Yeah, so private equity and I would expect other businesses will revisit practices that were honed during COVID in a post-COVID world. So the idea that I would fly literally halfway around the world, you can't fly further than that, halfway around the world for a meeting. I'm embarrassed how many times I've done something like that. That's not happening again. That's so inefficient. And what it takes is, on the other side of that meeting, the expectation that you don't have to do that, which is where we are. So I think we'll all become not just more efficient, it's healthier, it's productive to reconsider what we call ordinary course activities. So I think business travel should come down. Absolutely. Is it really important, as you are suggesting, to meet with someone face to face? Yes, in the case of a new relationship, but any existing relationship, I think, does just fine on Zoom. And we did have deal teams that ventured out to complete diligence. It was always to meet a management team. It was never because we said you got to do that. I was actually surprised when people were doing that. That will always have its place. I miss actually making new relationships. That's always been the top of the list for me for what's rewarding about this business. So I do miss that. But the existing relationships, unless they're all privately hiding something from me, I do not think have slipped one bit in COVID.
That's great. Do you see yourself maybe, as we think about this next generation of senior associates or vice presidents, or, how critical is it that they are in one of Providence's offices every day? I'm wondering, is that something you're rethinking at all?
Well, that's a great question, because if the need to meet in person, I think, varies significantly with the age group, experience group. And I think there's a group that really needs to come to the office, and I'm disappointed for them that they're missing out on forming new relationships and and they don't come with the same set of relationships someone more experienced has. They're forming relationships. And so at this point in their career, it's not a positive. I get that. By the way, I feel the same way. I'm active on a number of university boards, and I feel badly for students because they're getting robbed of an essential part of an education at that age. Um, the experience that comes from being with other people, diverse, uh, living with them, physically being with them, that is not the same remotely. In fact, not everything, there's a range of activities that if you were just to put it, the activity and does it work or not remotely, there are some that are operating at 100% or better, and there are others that got crushed. Obviously, hospitality. Yeah. What is a restaurant experience remotely? It isn't. And there are
takeout.
It's takeout. That's at home. That's just a convenient way of getting food.
Yeah.
And so the disparity in how COVID impacts people, demographics, industry is really, that's the issue. Because as an economy, it's moving along in the aggregate fine, except that we see high unemployment, we see certain industries that are crushed, and that's a societal problem, and we have to figure that out and support those folks. So we're fortunate in our space that we could go on for years like this if we had to. I don't think we will, thanks to vaccines. That next year we'll return to a new normal.
Let's talk a little bit. I want to circle back to media. I know we have limited time left, but back to the media industry, because I do think this pandemic and the shift to digital, to online work for many industries, and the media has affected kind of or accelerated trends in many industries, but particularly media, and we think about streaming and think about the many digitization of industries and how that's been accelerated. And I'm curious, as you kind of look out over media and communications over the next 5-10 years, what are some of the big changes that you envision perhaps coming out of this experience?
Well, a couple of things.
Or even the next year or two.
every decade has unbelievable innovation, whether it's technology, regulation, changing consumer behavior. It is the only thing we can count on, number one. Number two, in the moment, it always feels like, oh my gosh, what a sea change. And in some ways it is, but you don't have perspective on it when you're in the middle of it. So streaming is like the watchword of media right now. And it should be. I think for consumers, like all these trends, over time, or changes, I would say, big changes, the consumer's experience is enhanced. I believe that. That is for sure. Yes, for some companies it's a hit, and for others it's a new opportunity. That's also a good thing, because it would be a terrible world if the incumbents had it forever. So I'm comfortable with that. And as an investor that's nimble, that is opportunity. So I love that. So the demand set's growing, and so are the opportunities. Now, in streaming, there's a lot left to be resolved okay, Netflix is a winner, that's for sure. Disney, absolutely. Then there are a bunch that are going to have to find their place in a new ecosystem, and I give them different odds. And there'll be some changes. I mean, this is the first time we've actually seen a change in the construct of making movies, which was the lockhold on studios.
Yeah.
And they are amazingly, it seems, only recently focused on a world without theaters. And now it took COVID, but the trend line was always there. And that people got excited about it and expressed in valuations and conspicuously because of COVID, that, oh my gosh, we'll skip that window and go right to streaming. That was going to happen anyway.
Yeah.
And it was only a matter of time when sub count got high enough that it mattered more in terms of for the creators, for the studios to release through streamers than live and theater. So there was a big reaction when HBO Max, went to streaming and, with Wonder Woman and all that. Well, of course they did. Yes, it might have been a little better handled in negotiations with directors and producers and talent because they're two very different compensation schemes. That in the grand scheme, that's an easy adjustment, and that will happen. But if you're AT&T in that case, who should be making the decision, I mean, whatever the decision is should be in the best interest of AT&T, I would think. It matters much more how that streaming service does in the end than whether a movie in their slate has a big gross box office. Yeah. That doesn't matter, I don't think, in the end to their share price. So whatever you can do to boost subs is what they should be doing. And that shouldn't surprise anyone.
Yeah.
So I also think it's a good time for creators of content. Mm-hmm. If there's one, as long as I've been in this business, so that's over 30 years, and it's much longer studying it. Well, I don't mean to imply I was studying this in college. As I said, I was not. But you can look back, and what you see is this constant tension between distribution and content. It used to be over airwaves, it was broadcast television, then it was cable, then it was cable and satellite. Now it's death of linear and all those channels that were behind that, and the ascendance of streamers. And then you have the content and the proliferation of content creators because of the outlets. And that tension is really interesting because it should be mutualistic. If you're in the content business, you need great networks. They have to be ubiquitous, reliable. You need great devices. You need that. On the other hand, if you're in the network business, your network isn't worth anything without content. Whether it's professional or amateur, so they kind of go together, and over history says that if you're in one business, you tend to covet the other person's.
Yeah.
I think content should always be higher margin. There are services around networks where we play, which is very high margin. But the being a network, I think that game that's much harder to play. We're still doing it in Europe. In the US, consolidation has already happened to such a degree that it's way beyond us. You think of those large networks, they're nationwide.
Yeah, interesting. I want to get to a little bit, just briefly try and have some time to talk about sort of the future, because this past year, and I think just this month, you took on a slightly different role at Providence as part of this mapped out succession plan or leadership transition, whatever you want to call it, that was implemented. I think we wrote about it last year, where you promoted two senior guys on your team to co-chief executives, I believe, and you're four. Oh, it was four of them. You're right.
Yeah.
I'm sorry. I wrote that story.
I'll get calls from two of them
Yes,
I
like,
get
what are
calls
you
from
talking
4 of
about?
them. Which two? I thought there was
Which
4 of
two?
them. There were 4 of them.
Who's been dubbed? Yes, my mistake. But and then you step back to executive chairman. You know, you're still very engaged, but obviously thinking about the future, thinking about
Yeah.
this leadership transition. And I'm curious, one, maybe in what ways did this pandemic kind of influence your decision to execute on, I know you've been thinking about it for a while, but to execute on that plan? And could you walk us
Mhm.
through a little bit
Sure.
of that decision?
Uh, First, I had been thinking about it for for years. My goal was I wanted Providence to, it should last a lot longer than me. And I want to last a long time. I don't want to, I mean, in life.
Yes.
Uh, and it's also true that COVID accelerated my thinking on this, my views on this topic about timing and manner and who and how. I wanted to do it when we were doing well. We have a very good group of people. Always thought it'd be better to do that than when the environment is tough from an economic, from our business point of view, or there are big people issues. I wanted to deal with it earlier. And I personally started thinking about time, my time. I wanted to claw back some of my time. I'm still, as you said, actively engaged. Um, but I thought about, well, what are those activities where I can make a difference? Where investors will want to see stability. They love it when um, rising stars are both retained and incentivized. Uh, that's a great thing. And they also want to see stability um, and, um, and experience. The four, they're equal, and as they say, it's not accidental that two are in Europe and two are here. But we're all on the same page. And in some ways, it's more fun than it's been in a while.
Mhm.
And so and it was very well received by investors and inside. So those are the constituencies, inside and outside.
Let's talk two. I'm gonna, hopefully we can get to two last questions here. But one, you know, you've spent decades as a leader. And I'm curious, particularly since a lot of our audience may be this next generation of rising leadership ultimately, eventually. Um, what what are some of the pieces of advice that you would give
Yeah,
about leadership and the, you know, what makes a good leader, what you've learned from your own experience, to sort of young people who might become eventually the next generation of leaders
sure.
in the business world?
Yeah. Um, by the way, the four senior managing directors, yes, they're super smart. They've got very good investment skills, deal skills. They've got great records. You know them well. They're handpicked, but very relevant, I think, to your question. Um, they're natural leaders. They're great culture carriers. That was essential to me. And so there's a lesson there that relating and communicating with people, um, I think, is a underappreciated skill. And whether it's career paths, when you're doing something that's collaborative, and many activities are, you need people to, and involving lots of people, those leadership skills. And when I talk about culture and communicating, those are essential ingredients to leadership. Um, the I consider myself an accidental leader. I just wanted to work with management teams. This is a long time ago, and help build businesses. I loved working with really talented people. It's been the greatest reward to me in what I do, and has sustained me all this time. Leadership is about character. We saw this conspicuously, I would argue, with our leadership in Washington. when there's no, when the, and this is not a political statement, when the character is flawed, the outcome is flawed. Businesses aren't any different because people are always taking the message from the top, and and there's always work to be done when someone gets a little bit out of the goals that you would hope, or that, you know, for the firm, you've got to coach them back to what you want the firm to represent. That's never ending work. And so the influence that leaders have is really significant. That's inside. And today it needs to be outside too. One of my worries for people who are getting into business today or are already there, but early in their career, is they won't have the time because of demands on them, be it family or the business, to be meaningfully engaged in nonprofit activities that are socially or educationally, scientifically, they're important. And so I worry about that. And we encourage that at Providence.
Oh, that's good. And I know, to that end, just sort of brings me to kind of this last topic. I know we're probably running a little over on time, but to that end, your own sort of philanthropic activity, by example, you are a part of a list of growing growing affluent, I don't know, billionaires for another, for lack of a better word, that have signed the Giving Pledge, which publicly committing to give away the majority of your wealth. I think David Rubenstein from Carlisle is also on that list, and there are a number of other people, but I know you publicly came out and put your name on that list. I'm trying to remember whether it was 2016 or 17. Can you tell us a little bit, how's that going? Can we have an update and kind of...
It's really, it was not an easy decision, and it's not for the reason you might imagine, or the viewers. It wasn't about the commitment, because actually, which for the Giving Pledge is 50%.
Okay.
Your net worth to philanthropic causes. I had actually legally and irrevocably done much more than that, and personally. The issue for me was being public about it. That's what I struggled with.
Why?
And in the end, there were two reasons why I did it. And this is in a letter. When you contribute, when you sign up, you write a letter that's available at the Giving Pledge, and I think my letter is in the Smithsonian now.
Yeah.
And it's a personal letter. And I haven't read it in a while, but I would hope and expect that every word is still true about the why and how I feel about it. So, first of all, I do think it's one of America's great qualities. And I don't mean giving large amounts. I mean giving whatever it is. And it's a relative issue, not an absolute issue, that it's widespread. That's something to be cherished and celebrated. We do a lot of that in the US. And at unacknowledged levels. And so that's very important, I think. The other is that I thought by the act of being public, if it would influence others to do more, that would be a reason to do it. That, you know what, I should do that too. Because we spend so much time. If fortune has smiled on you, it was probably accompanied by a ton of work and almost monofocused for many. This is what they did. And then only later in their career do they start thinking about, I mean, Warren Buffett's a great example. Well, he's a along with Bill Gates in leading the Giving Pledge. I think it's fair, and we've had these discussions, that was late in life for him. I mean, phenomenal, in so many ways. But actually, if you look at the preference curves of those who need help, their discount rate is so high. They want it now. They can't wait. And so the idea, most of us tend to look at this later than ideal from just a holistic perspective. We need to start earlier. And I think everyone actually ends up there. What else are you going to do? You can't take it with you. So I think starting earlier is good, and I wanted to encourage that. And I thought being open about it would be helpful.
And you set up a Center for Entrepreneurship, I know, at Brown. So you've definitely demonstrated that at your alma mater. I'm curious, any other projects now in the works or any other areas with,
Yeah, so I do. Yeah, so the Entrepreneurship Center at Brown, there were reasons for why Brown. I thought it was a great fit for, it's just my view on how innovation, how entrepreneurship happens. The student body lines up well for that. And the environment at Brown, but it's also, and it's not just for profit. Yes, there are many for-profit endeavors that are hatched there, but it could be to organize a cause, a philanthropic cause. That's also entrepreneurship. And the skills that hopefully students are acquiring in the center would apply equally in that setting. So it is also, as with philanthropy that we were talking about a minute ago, it's a great American quality too. And it doesn't exist uniformly around the world. In fact, some languages don't even have a word for entrepreneurship. It's that foreign. So I wanted to encourage that, and that seemed like a good place to start. So there were motivations there. I'm working on something else right now in healthcare, happens to be not in Rhode Island, but with national and international impact. So I'm excited about that. And as with most things, it starts with a personal experience and it resonates, and you feel like, now that I'm aware, I want to do something. And also I'm a believer in science and basic research, hence Rockefeller, which is really biomed research, Institute for Advanced Study.
Well, thank you. Maybe we could wrap up. Just I'll go through one or two questions. I like to call it a speed round, where I'm going to just read the first part of a sentence, and you finish it. It can be super pithy, so I'm going to go real quick through this, and we'll see what you come up with. But the first one is, the best thing about a career in private equity is?
Oh, working with really talented people in companies or your partners. That's the rewarding. That has kept me going.
Okay. The worst thing about a career in private equity is?
Those people. No, that's a joke. The worst thing is time. I think to be good, to do your job well, it takes a lot of time.
Yeah.
Just that, anyone who thinks not should find something else.
Last one. After I'm gone, I would most like to be remembered for?
Oh gosh. He did a great job as a dad. I'm not trying to I'm just saying, if that's how it works out, I would be super happy. And high integrity, and was a positive force in the communities that he reached.
Excellent. Well, thank you so much, Jonathan, for your time and your candor today. I really appreciate, and I'm sure our audience does, your sharing all these experiences and your thoughts with us. And thank you to the London School of Economics for having us.
Yeah, no, thanks. It was a pleasure talking to you. And thanks to LSE for organizing this.